the reality is if you just have one that's going to have all your active income, your passive income, all your development fees, construction, if you're your own contractor, your construction fees, all of that technically can go through one entity. And then the property holding company can be a different, but the whole idea is just to separate the type of income. Is that right?
I think a good visual is like, okay, you're you, right? So I'm Katie and I have a left hand and right hand. My left hand is everything rental related, whether it's like a Main Street rental, a rental I'm building, that's going to be on my left hand. This is a set of entities, right? One or a series, whatever it is. And then my right hand is me actively doing stuff. That's me being a property manager. It's me being a realtor, being a developer, right? That's my right hand. And so those two kind of don't touch each other, except me. I'm in the middle. I own both entity or sets of entities.
So your intent from the beginning is important, right? When it comes to taxes, because my understanding is if I bought a house to flip and I can't sell it, so I turn it into a rental, at some point in the future, when I sell it, it's still active income because the original intent was to flip. Is that even true?
No, it's actually the reverse. So in that scenario, I intended to flip it, but I kept it as a rental. It's going to be treated as a rental because
when you eventually sell it. So it's capital gains instead of ordinary.
Yeah, because the IRS will see rental income, right? You'll have rental income for a few years.
So from a development perspective, it doesn't really matter if I don't know what I'm going to do with it. Should I always say the plan is to develop this and keep it as a long-term hold? And then if I sell it, I sell it. But it sounds like it doesn't really matter what my original intent is. It will only matter whenever I choose to do something with it.
So intent is important in a scenario where you bought a property, you rehabbed it, and you sold it. And so the question becomes, was that a flip or was that a burr? And the difference would be like, okay, my intent all along was to hold this as a rental, right? I bought it, I'm gonna rehab it, I'm gonna keep it as a rental. But something changed. I couldn't do it because of health issues. I couldn't keep it anymore. I'm not keeping it anymore because I was going to do short-term rentals and now they changed the code and the permits. I couldn't get one, so I sold it without ever renting it. Those are scenarios where we can still claim that it was a rental and get lower capital gains tax treatment as long as I can show my intent was for it to be a rental, except for the fact of these changes that happened. So that's typically where we see that, where intent is important, because otherwise, I intend on keeping it, but I sold this, now I got to pay so much higher taxes because it's a flip, right? That's where it is, it's important.